Hi, this is CSI Akash from Hubli. So as you all know, the government has already introduced the new Income Tax Bill 2025. So I'll be coming up with a series of videos. I'll be doing the comparative analysis of the existing Income Tax Act 1961 with the proposed finance bill which is introduced in the Parliament, that is Income Tax Act 2025. So in today's video, I'll be discussing the following topics: the books of accounts, tax audit, presumptive taxation for residents, and the presumptive taxation for non-residents. To begin with, the first topic, books of accounts. So section 44AA of the existing Income Tax Act 1961 says that if your income is more than 1,20,000 or if your turnover is more than 10 lakhs in any of the three preceding years excluding the previous year, if you cross those limits, then you are required to maintain books of accounts. In case of new business, if in the current financial year, in the first year, if you expect to cross income of 1.2 lakhs or a turnover of 10 lakhs, in that case you need to maintain books of accounts. So this is one set. But if you are an individual or if you are a HUF, this limit of 1.2 lakhs of income will become 2.5 lakhs and the turnover limit will be increased from 10 lakhs to 25 lakhs. So this is the turnover which is currently prescribed to maintain books of accounts under the existing law. Again, if I go to the new law, then under the new law, this is governed by section 62. The section 62 of the proposed income tax bill 2025 has set up with the same limits, wherein income 1.2 lakhs or turnover 10 lakhs. If you are an individual or HUF, then income 2.5 lakhs. But there is a minor mistake, I guess it is a drafting error which will be corrected in the act soon. For individual and HUF, the turnover currently under the existing law is 10 lakhs, is 25 lakhs, but in the proposed new bill they have put it as 2.5 lakhs. Ideally it should have been 25 lakhs. I believe this should be taken care when the bill becomes an act. And apart from this, who are required to maintain books of accounts? If you are opting for presumptive taxation and if you declare lesser amount of profit, so under presumptive taxation, which we'll be discussing in detail in the further slides to come. So if you opt for presumptive taxation and if you want to declare lesser profits, then mandatorily you need to maintain books of accounts. So the same provision is continued in the new section as well. So this is a comparative analysis of books of accounts. So the limits have been same. The only mistake which is there in the proposed bill is that in case of individual and HUF, the turnover limit was supposed to be 25 lakhs, which they have currently written as 2.5 lakhs, which will be for sure rectified. Apart from that, there are no changes in this section. Going forward to the next section. So the next section which we'll be discussing about is a very important section, that is a section of tax audit, currently governed by section 44AB of the Income Tax Act 1961, and in the proposed law section 63 would be governing this section. So tax audit is a very important section. So to whom tax audit is applicable? So if you are into business, if for your business, if your sales or turnover or gross receipts as the case may be, if is in excess of 1 crore, then mandatory you need to get a tax audit done. However, this limit has an exception. So if out of your total receipts more than 95%, at least 95%, or out of your total payments, at least 95% of your payments, if they are through the banking channel. When I say banking channel, it includes everything: your NEFT, RTGS, BHIM, UPI, debit card, credit card, or any other specified mode. Includes also account pay check. Be mindful, for my dear friends. So whenever a check which is not an account pay check, so if it is a bearer check or if it is a cross check, that will be deemed as a cash. It will not be deemed as a banking channel. So check should be only account pay check. Other than account pay, if it is a bearer check, it will not be considered as a banking channel, or if it is a cross check, again it will not be treated as a banking channel. So if more than 95% of your business, in case of receipts also, in case of payment also, is through banking modes, then your tax audit limit would be 10 crore. So normal limit is 1 crore, but if you are more into digital economy, so if you are not promoting cash transaction, more than 95, at least 95% of your receipts and payments are in excess of, are in the specified banking channels, then the limit applicable is 10 crore. The same limit has been carried forward in the new act itself. So there is no change if you are a business person. Coming to profession, so the current limit, if you want to get a tax audit done, the limit applicable to is 20 lakhs. So if your gross receipts are more than 50 lakhs, then you have to get your tax audit done. The same limit is carried forward under the new, this one as well, under the new law as well. Coming to another set of people who needs to get the tax audit done are those people who are opting for presumptive taxation and they want to declare lesser profits. So there are specific presumptive taxations which we will be discussing in detail. So if you are opting for presumptive taxation and if you want to declare lower limits, lower profits, then mandatory you have to get a tax audit done. Again, the same provision has been carried forward in the new bill as well. There is no change. Again, who will conduct tax audit? As said, tax audit will always be conducted by a chartered accountant. Even in the new income tax bill, it will be conducted by a CA only. There were many controversies going on with respect to giving tax audit power to our fellow professionals that are company secretaries and CMAs. The same has not been done. So CAs will continue to be the only persons who will do tax audits. What is the due date? The due date will again remain the same 1 month before filing income tax return. So what is the due date? Normally for audit cases, it is 31st October. So tax audit due date would be 30th September. So again, there are no changes. So in short, there are no changes under the tax audit governing provisions under the existing law and the proposed new law. Let's proceed further. So the next area is presumptive taxation. So let us divide it into residents and non-residents. So first we'll discuss a very important section, section 44AD. So this section is applicable only in case of resident individuals, HUFs and firms. But in firms, LLPs are not considered. So in the proposed law, presumptive taxation series is governed by section 58 for residents and section 61 for non-residents. So specifically section 58 subsection 2 serial number 1 talks about corresponding section of 44 AD. So what is the limit? So if your turnover is up to rupees 2 crores, then you can declare 6% or 8% of as your deemed profits. So the same limit of 2 crore is applicable in the new law as well. Again, this has an exception. If out of your total receipts, at least 95% of your receipts are through banking channel. Again, when I say banking channel, what is included? Account pay check, NEFT, RTGS, BHIM, UPI, debit card, credit card. So again, cash is not included. Account other than account pay check, that is a bearer check, does not count to be a banking channel, and cross check is also not to be considered as a banking channel. So more than 95% of your total receipts, if they are through a banking channel, then in that case you can, even if your turnover is up to 3 crore, you can opt in for 44 AD. So what is the benefit if you opt for 44 AD? If you opt for 44 AD, straight away out of your total turnover, 8% would be your deemed profit and gains for business profession. So your profit would be straight away 8%. However, again for this there is an exception. Out of your total turnover, whatever turnover has been realized through the specified banking channels, then instead of 8%, you can declare only 6% as profit. So this is the benefit available. So the same has been carried forward in the new law as well. There is no change. However, there is one minor change wherein under the existing law, your turnover should have been realized on or before the due date of return filing. Even on those cases, 6% benefit was given. The same words are missing under the new provision. So under the new section, I think the interpretation which rolls out is that only when your turnover is realized in the previous year, on that turnover you can declare 6%. So the benefit of extended due date wherein the turnover, even if it was realized on or before the due date of return filing, so that provision has been done away with in under the new act, under the new provision. Apart from this, all other sections will remain same. The lock-in of 5 years, if you opt in for 44 AD, you have to stay in for 5 years. If you opt out, again you have to get mandatory tax audit done for the next 5 years and you will not be again eligible to opt for 44 AD. That will remain the same. Again, if you want to declare lower profits, lesser profits, again you have to maintain books of accounts and you have to get the audit done. So all other provisions will remain same under 44 AD. Next, 44 ADA. 44 ADA is for professions. 44 AD was for businesses and for 44 ADA it is for professionals. The corresponding governing law is section 58 subsection 2 serial number 3. Again, this section is applicable only to resident individuals and firms. It is not applicable to HUFs and it is also not applicable to LLPs. Again, who can opt in for these sections? If your gross receipts are up to 50 lakhs, you can opt in for 44 ADA. Again, there is an exception. If more than 95% of your total receipts are through banking channels, even if your turnover is up to 75 lakhs, you can opt in. So you can get a higher limit of 75 lakhs. What is the benefit? Out of your total turnover, straight away 50% would be your business income, profits or gains from business profession. No need to maintain books of accounts, no need to get them audited. Again, exactly the replica of 44 ADA has been carried forward in the new law. There is no change. Coming to next section, that is 44 AE. Again, this is for any SSE, maybe a resident, non-resident, individual, HUF, firm, company. For all the SSEs, what is the existing provision? The existing provision says if you have up to 10 vehicles, if you own up to 10 vehicles, you can declare income under the presumptive basis. How will your income be calculated? Your profit will be calculated for every heavy vehicle. So what do you mean by heavy vehicle? If the weight of that vehicle is more than 12,000 kgs. In that case, what would be your deemed business income? The income would be calculated at the rate 1000 rupees per ton per month will be your business income. So for heavy vehicles, what is your deemed income? 1000 rupees per ton per vehicle. If it is a other than heavy vehicle, other than heavy vehicle means a smaller vehicle. In that case, the presumptive income would be rupees 7500 per vehicle per month. So or part thereof. So again, if it is a small vehicle, 7500 rupees per vehicle would be your deemed PGBP income. Again, the same set of provisions are also replicated under the new law, except for the fact that, again, I suppose this is a drafting error. In case of heavy vehicle, what is mentioned in the law is just 1000 rupees per ton. Per month is not mentioned. Again, this implies that the total for the entire year it would be only 1000 rupees per ton. That would not be the case. Ideally they will change it. So when the bill becomes an act, they will change this. So apart from that, there is no change. One specific thing, in case the assessee is a firm, only for this section the interest and salary whatever we pay to the partners, that is allowable even against the presumptive income. This is only when the assessee is a firm. Again, these are subject to that limit up to 6 lakhs of book profit, 90%. Apart from that, 60%. So that limits we can avail. So this is the section 44 AE, corresponding section 52 subsection 2 serial number 2 of the proposed bill. Again, there are no major changes. The one change which I have mentioned might be a drafting error, which will be taken care when it becomes an act. Going to the next set of sections, these are presumptive taxation for non-residents. To begin with, section 44B. So what is section 44B? If a non-resident assessee is in the shipping business, so what will be his profit percentage? Straight away 7.5%. 7.5% of what? So this logic will remain same for all the non-resident presumptive taxation, wherein the profit percentage would be percentage of amount accrued in India or an amount received in India. So in this case, in case of shipping business, whatever amount is received in India or whatever income is earned due to the business given from India, in that case, flat 7.5% would be your business profit. Again, no need to maintain books of accounts, no need to get them audited. Again, under the existing law, this 7.5% is a flat rate. You cannot declare anything more than that, and you don't have an option to declare anything less than that. As against, under the new law, this is the change. You can declare lesser profits, again subject to conditions. What are the conditions? If you want to declare lesser profits less than 7.5%, you need to maintain books of accounts, you need to get them audited. Again, this is the difference. Under the existing tax law, in certain cases, in case of non-residents, the government did not provide for any option to declare lesser profits. However, in the new law, they have given option to declare profits at a lesser rate. Again, it comes with a condition that you need to maintain books of accounts, you need to get them audited. So that was section 44B. Again, all other conditions will remain same. Coming to section 44 BBA, again it is for aircraft business for a non-resident. So if a non-resident is into aircraft business, what is the profit percentage? The deemed profit percentage is 5%. Again, it is a flat rate. You cannot declare something more, nor you have any option to declare something less under the existing regime. But under the new act, you have an option to declare less than 5%. Again, it comes subject to the condition that you need to maintain books of accounts, you need to get them audited. All other conditions will remain same. Coming to the next section, 44BB, wherein non-resident assessee which is providing services with respect to the extraction of mineral oils. Again, the flat rate was 10%, but in this case there was no restriction as to declare lesser rates. So you had an option to declare lesser profits. The same has been done in the new law also. Again, flat 10%. You can also declare profits at a lesser rate, again subject to the condition. The condition is that you need to maintain books of accounts, you need to get them audited. There is no major change in this. Coming to the next section, 44 B, wherein a foreign company. Be mindful, this is specifically only for a foreign company. All other sections which I was discussing under the head non-residents, it was for non-resident. So non-residents includes foreign company. So, but this specific section, 44 B, is only for foreign company. So if there is any foreign company which is into civil construction of a turnkey project, approved turnkey project, then 10% would be a flat rate. Again, there was no option to declare this one. Again, it is a flat rate. Again, under the new law, you can declare it as a at a lesser rate subject to the conditions. Going ahead with the next set, that is 44 BBC. Again, this was a new section introduced by Finance Act 2024, wherein if a non-resident is in the business of operation of cruise, the flat rate was 20%. Again, in this section specifically, there was no mention about it has a bar on declaring lesser profits, but it has, in the new law they have been given a benefit that you can declare lesser profits. Again, subject to a condition, you need to maintain books of accounts, get them audited. So this is the difference here in this section. Going to a new section, this section was itself introduced in this budget 2025, wherein if you are a non-resident and if you are providing services with respect to electronic manufacturing facility in India to a resident company, then 25% would be your deemed income. Again, 25% of what? As said, the logic is very clear. 25% of income either received in India or accrued in India. Again, there was no specific, there was a specific reason they had not given any option to declare lesser profits. Only for this specific section, this bar of declaring lesser profits is still applicable under the new law. So for all other non-resident sections, wherein even though there was no option to declare lesser profits under the existing law, the new law gave them an option to declare lesser profits and subject to the conditions. But only for this specific section, even under the old law you cannot declare lesser profits, and under the new law also you cannot declare lesser profits. Also, tax audit is mandatory for these cases under the new law. This is very specific. I don't know what is the exact logic behind this, because they have given the benefit of declaring lower profit to all other non-resident presumptive taxation sections as we discussed previously, but for this specific section they have not given benefit. Specifically, they have excluded this point, serial number 6, from that list. So for this you cannot declare lesser profits. Also, tax audit is mandatory in this case. So again, this is the question mark. Why is this like this? Let us wait for the bill to get converted into the act, and we'll try to get the answer to this. So these are a set of amendments, like set of changes I wanted to compare and contrast with the existing law with the new proposed law. So if you have any queries, if you have to take anything, if you want to discuss anything, drop down a comment. I'll get back to you. Hope you'll have a good day, and I'll also be coming up with a series of other videos wherein I'll be discussing the other provisions, comparing the old act with the proposed act. Thank you and have a good day.